This is how the United States will reset the entire debt system, and most people never see it coming. Not because the signs aren't there. They're everywhere, hiding in plain sight inside legislation that got almost no mainstream coverage, inside policy decisions, dressed up in language so deliberately confusing that most people just tune out and go back to scrolling. That's by design. Keep people distracted, focused on the noise, the politics, the daily outrage cycle. While all that theater plays out on the surface, the most consequential changes to the global monetary order in modern history get quietly assembled in the background. By the time the average person figures out what happened, the repricing will already be done. The wealth transfer will already be complete, and the window to position yourself on the right side of it will have already closed. Now, before we dive in, the only thing I ask in return for all the work that goes into making a video like this is that you hit that like button and don't forget to subscribe. Every time you do that, YouTube pushes this video out to more people, which helps us prepare more people for what's happening. The United States is currently carrying more than $38 trillion in debt, and the truth is, by every historical precedent, the current system should already be under extreme stress and really collapsing at this point. Yet the USA, the country, continues operating as if nothing is wrong, and financial markets just keep hitting all-time highs while the real economy is deteriorating. In times like these, the best way to secure and maintain your retirement is to maintain a balanced portfolio that can ride through this economic chaos. With that in mind, I've developed a list of the best 6 stocks to own in 2026 that you can download for free at free.stockscommunity.com. And if you're actively managing your stock portfolio, head over to stockscommunity.com to learn how I buy and sell stocks at the right time. I'm currently offering a completely free 10-minute training on how I spot stocks before they go up. This is the same training that one of our members watched and went on to make thousands of dollars in a day. You can view this 100% free training at the link in the description below. As always, nothing in this video is financial advice. Do your own research. So let's walk through exactly what's happening, why it's happening right now, and how the stock market fits into this picture in a way most people are completely misreading, and what you can actually do about it before the next phase kicks into gear. Let's start at the foundation, because if you do not understand what money actually is, not what you were taught in school, but what it really is, then nothing else is going to land. Real money must do 3 things. It must work as a medium of exchange so you can buy and sell things. It must work as a unit of account so you can measure and compare value. And critically, it must work as a store of value, meaning the purchasing power you hold today is meaningfully preserved tomorrow, next year, and a decade from now. That third property is where the entire modern financial system completely falls apart. What we call money today fails that third test entirely. It's not money. It is currency. And more specifically, it's debt. Every dollar in circulation is either a central bank liability, created out of thin air at the click of a button and used to purchase government debt, or a commercial bank liability, created the moment a bank issues a loan. That loan shows up as a deposit in the borrower's account, and boom, new money exists. Now, through work or production or any real creation of value, but just through the issuance of debt. So when people say money makes the world go round, what they're actually describing is debt making the world go round. And that distinction matters enormously for everything that follows. Contrast this with gold. An ounce of gold today is an ounce of gold tomorrow. It cannot be created at the click of a button. It has to be physically pulled from the earth using real energy, real labor, real time. Because of those constraints, a gold-based monetary system naturally self-regulates. When prices are high, it makes sense to mine more. When prices are low, the supply stabilizes. There's a feedback mechanism. Our fiat system has no such mechanism. A small group of central planners decide how much currency gets created with essentially no hard constraint other than political discipline, which turns out to be an extremely weak guardrail when debt levels get high enough. And because there's no hard limit on creation, each unit of currency loses value over time as more gets produced. Simple supply and demand. Now here's where the pressure really builds. Technology is a powerful deflationary force. It increases productivity, lets economies get more output from the same input, and pushes prices down naturally. AI and robotics are taking this further than anything before, directly targeting the need for human labor, concentrating wealth into the hands of those who own the technology while not creating anywhere near the volume of new jobs that previous technological revolutions produced. So the system faces a collision. On one side, a debt-based monetary system that absolutely requires ongoing inflation to function. On the other, technology-driven deflation, pushing relentlessly in the opposite direction. Governments respond to this collision the only way they know how, by printing more money, expanding the supply, cutting rates toward zero, doing anything to keep the debt machine running. And that's exactly where we're at today, except the debt has now grown to a scale that makes the old tools insufficient on their own. The US is carrying a level of debt that, by every historical precedent, should already have the system visibly crumbling. Foreign buyers are stepping away. China's been selling treasuries. Japan's been selling treasuries. Other major economies are quietly diversifying. Interest payments alone now exceed $1 trillion per year, more than the entire defense budget, more than all of Medicare. And the debt is growing by roughly $1 trillion every 100 days. Cutting spending enough to fix this is politically impossible. Raising taxes enough to fix it is off the table. That leaves one option, the same option chosen at every major monetary turning point in American history. Devalue the debt, make the currency worth less so the obligations shrink in real terms. In 1933, Roosevelt revalued gold effectively overnight, devaluing the dollar by about 67% and making government debt dramatically easier to surface. And in 71, Nixon ended the dollar's convertibility to gold, breaking a promise made to every foreign holder of U.S. currency and beginning a debasement that has since cost the dollar nearly 90% of its purchasing power. Since 2008, quantitative easing became the preferred mechanism, and from 2020 to 2025, the money supply expanded by more than 40%, shrinking the real burden of government debt while prices of everything that ordinary people needed exploded. But domestic inflation creates political pressure. When government and grocery bills get high, painful, and housing gets unaffordable, people noticed and they push back. So the U.S. has historically exported much of that inflationary pain abroad, using the dollar's reserve currency status to spread the monetary stress globally. But that advantage is eroding as foreign nations reduce their dollar holdings and central banks around the world quietly pile into physical gold at record rates. So who fills the gap as foreign governments step back from buying U.S. debt? This is where the new mechanism enters the picture, and it's genuinely one of the most sophisticated pieces of financial engineering in modern history. The answer is stablecoins. The Genius Act established a legal framework requiring every dollar-backed stablecoin to be backed by cash or U.S. treasuries. So when someone buys USDT or USDC, the issuer is legally required to purchase U.S. government debt. Every stablecoin issued must be matched by a treasury bond. By design, as stablecoin adoption grows, demand for U.S. debt grows right alongside it. The government has engineered a built-in self-reinforcing globally distributed buyer of its own obligations, and today stablecoin issuers already hold more U.S. debt than many significant national governments. The mechanism solves two problems simultaneously. It replaces foreign governments as buyers of U.S. debt, and it distributes that debt burden across hundreds of millions of individual users worldwide, instead of concentrating it in central banks that could coordinate a rapid exit. Someone in Venezuela using stablecoins to escape local hyperinflation. Someone in Eastern Europe moving money across borders for businesses. A family sending remittances home from abroad, all of them become indirect buyers of U.S. treasuries without ever thinking about it. And the political elegance of it is that stablecoins look like decentralized private innovation rather than monetary policy. There's no single institution to blame, no single policy decision to point to. The devaluation continues, purchasing power keeps eroding. It just gets distributed globally and disguised as technological progress. The pattern has not changed. 1933, 1971, 1985 with the Plaza Accord deliberately devaluing the dollar by about 25%. 2008 with quantitative easing, and now the stablecoin era. The tools evolve, the strategy stays identical. Devalue the obligations, never default, just make the currency worth less so the debt shrinks in real terms, while most people are too confused by this mechanism to understand what's happening. Phase 1 of this cycle, the legislation and infrastructure, was largely completed in 2025. Phase 2, regulatory clarity and mass adoption, is accelerating right now, and there will be a next catalyst that expedites adoption to the next level. The groundwork is all in place. Now here's what most people are completely misreading about the stock market in the context of all this. There's a signal circulating in financial circles right now called the blow-up indicator. In recent trading sessions, roughly 23% of S&P 500 stocks have dropped 7% or more in a single day. Historically, when this signal fires, the average drawdown that follows has been around 34%. It appeared before the dot-com crash, the 2008 crisis, the COVID crash, and the bear markets of 2022 and 2025. So at first glance, it looks alarming, but the context underneath it makes this moment fundamentally different. The 10 largest stocks in the S&P 500 represent about 40% of the entire index, meaning the index can rise while hundreds of companies underneath it are struggling. And it can look terrible while hundreds of companies underneath are actually thriving. The index number is often a misleading picture of what's really happening across the full market. In 2022, the warning came months early for those paying attention. More stocks were falling than rising daily, while the index still crept higher because the mega-cap names were masking the deterioration beneath. Anyone watching the full breadth of the market rather than just the headline number could have gotten out with roughly 4% to 5% of losses and sidestepped most of the damage. Today, the picture is the opposite. Some of the largest names in the index, companies with significant individual weightings, are actually down. Historically, that alone would have dragged the whole market significantly lower, but it is not, because the breadth of participation across the full market is genuinely healthy right now. More stocks are making new 52-week highs than lows. The ratio of stocks advancing versus declining is moving in a positive direction. Well over 60% of stocks remain in long-term uptrends across the full universe of publicly traded companies. The smaller and mid-sized companies are carrying the market while the big names work through their individual challenges. When those large names regain their momentum and add their weight back on top of that already healthy foundation, the historical pattern suggests a powerful and sustained move higher. The volatility is real, and it's happening for real macro reasons, including a dollar losing value in a deliberate and measured way. Governments diversifying away from U.S. assets, commodities making wild swings. But the fact that roughly a fifth of the S&P 500 can take dramatic single-day hits and the broader market holds near its highs is a sign of remarkable underlying strength, not imminent collapse. The signals look far more like the conditions of the bottoms at 2002, 2009, and 2020, some of which were some of the best buying opportunities of a generation, than the conditions that preceded sustained bear markets. Owning quality productive business in this environment makes sense because when a currency is being deliberately devalued, the nominal value of those businesses tend to rise in that same currency. We've seen this repeatedly throughout history. During inflationary monetary transitions, stocks frequently rise sharply in nominal terms, not because the underlying businesses became dramatically more valuable, but because the currency measuring them was being destroyed. Not every company will thrive. Many will struggle, but the ones with genuine competitive advantages, real demand for their products, strong balance sheets, and clear positioning within the industries that matter for the next economy, those will not just survive this transition, but emerge from it significantly stronger. Which brings me to something specific I want to spend a few minutes on. Because everything we've discussed today, the digital infrastructure being built, the new financial architecture taking shape, the AI and technology wave, the need for physical backbone in an increasingly digital world, all of it points towards a company that is genuinely well positioned right now and whose name you might not immediately associate with any of this. That company is Corning, ticker GLW. Corning makes specialty glass, ceramics, and optical fiber, and those materials are foundational to the physical infrastructure that makes the digital economy function at its most basic level. Think about the fiber optic cables that carry internet, the traffic across continents and under oceans. Corning is one of the dominant global manufacturers of the optical fiber those cables require, and right now there's a massive and accelerating build-out of fiber infrastructure happening globally, driven directly by the bandwidth demands of artificial intelligence, cloud computing, data centers, and the digital financial architecture we've been discussing. Every new data center built to support AI workloads requires fiber. Every cloud provider expanding network capacity requires fiber. Every telecom company upgrading its infrastructure requires fiber. Corning sits right at the center of all of that physical demand. And here's what makes it particularly interesting in the context of everything we talked about today. It's not a speculative bet on some future technology that may or may not pan out. It's an ownership stake in the physical connective tissue that the digital transformation absolutely requires, regardless of which software platforms win, which AI models dominate, or which blockchain networks become the standard. The fiber has to be there. Corning is one of the most established and technically capable builders of that fiber in the world, with real engineering expertise that is genuinely difficult to replicate quickly. In an environment where the importance of owning real productive assets rather than holding a currency losing purchasing power every day has never been more clear, a company like Corning represents exactly the kind of ownership that's historically held and grown its real value through monetary transitions. It makes things the world demonstrably needs. As more of this new architecture gets built, benefits from the broad structural shift towards a more digitally connected and AI-powered economy, which is not reversing regardless of what happens to any individual name within that space. That combination of physical necessity, established technical mode, and direct exposure to the infrastructure build-out being driven by AI and the digitization of finance makes GLW one of the more grounded and thoughtful ways to participate in this transformation without chasing speculative risk. And that matters right now because discernment is everything. Not every company mentioning AI in its presentations will be a winner. The value is in identifying businesses that serve genuinely structural roles in what comes next. To bring it all together then, the US is executing a debt reset in real time using the same basic strategy deployed in 1933, 1971, 2008, but with a new mechanism built around stablecoins and digital financial infrastructure that distributes the devaluation globally and disguises it as technological innovation. The stock market's reflecting the volatility of this transition with surface signals that look alarming, but whose underlying breadth actually resembles conditions that preceded major recoveries rather than sustained crashes. The big macro forces are all pointing toward a more complete and visible transition at some point ahead, and the question for anyone listening is not whether it is happening, but whether you are positioned ahead of it or behind it. Quality productive assets, physical necessities, selected digital infrastructure with real utility, and grounded equity ownership in companies that make things the new economy genuinely needs. Those are the kinds of positions that history suggests carry value forward when systems change and currencies get redefined. Stay curious, stay skeptical of the narratives being handed to you, and stay focused on what is actually happening beneath the surface. So, what did I miss here, and what would you push back on? Let me know in the comments. And if you're managing your portfolio independently and want to know how I spot stocks before they go up, watch my completely free training at stockscommunity.com, where I go over the same methods I teach my students on how to find the best stocks, spending just 10 minutes in front of their computers a day. And if you already have a portfolio going and you want to make sure you're in the best stocks in the market, download my best 6 stocks to own in 2026 for free at the URL free.stockscommunity.com. And if you found this information valuable, smash that like button, subscribe to the channel, and share this with somebody who needs to hear it, because the people who prepare themselves and stay one step ahead of the everyday person will always come out ahead in the long run. Thank you for watching, and I'll see you in the next one.